Hi, guys, and welcome to the 25th episode of WTW, the weekly trading wrap up, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Before we begin, let's give a shout out, a tribute to the one and only Warren Buffett. He retired this week. Berkshire Hathaway has been on a tear. I mean, he's literally a legend. There will never be another person like that. He rode the wave of American exceptionalism from the 1930s, 40s, all the way to now. I mean, this guy's an absolute legend. Let's look at Berkshire Hathaway here on the chart. Berkshire Hathaway. Go to a monthly chart. Look at that. Since 1979, from I don't know, nothing. What was the price then? About $1,000 per share. What did it start at? I think it started at $300 a share, and now it's 770,360. The A shares. That's an incredible performance. Okay, so shout out to Warren Buffett. Okay, let's go back to the SPY here and get out of the month, go into the day. Okay, so as usual, we start off with the S&P 500 daily chart. This is the week of the 5th of May. Okay, Monday, Tuesday, Wednesday, Thursday, Friday. As you can see, it was a nothing week. It was a consolidation week. And it was also a pretty light week on the macro. But first, before that, we're going to talk about the technical picture as we see it, and we'll get to the fundamentals later. So the technical picture is pretty much the same as last week. Okay, we're coming off huge, bigly from here, from the like almost a 20% drop. But from here, this was the April Liberation Day surprise of Trump's, and when the market freaked out, fear-based move all the way down, as you can see here. This is the volume was massive, okay? So it came down on high volume and then rebound afterwards, okay? What I see technically speaking is like pretty much the same as last week. We can go to the, let's show the moving average. As you can see here, the 200 is the blue and the 50 is the red. So we're getting close to the blue, which could serve as resistance. So technically, if we're trading under the 200-day moving average, we are in bearish territory. However, we checked a lot of boxes, a lot of bullish boxes last week. Okay, we had a higher low. We broke this first bounce point, and we're hovering around the highs, the recent highs. So technically speaking, bearish, but because we tick so many boxes, let's call it neutral, on the way to turning bullish, actually. As we mentioned, nobody in his right mind, even now, but back then, nobody thought that we were going to break the highs and go much higher. In fact, everybody still thinks we're going to have a recession this year. It could happen. I'm just saying that nobody's positioned that way. And we can see that with the fear and greed index was at 3, and now it's at greed. It's at 62. Okay, we are getting to the part. It just started though. There's like 1 week of greed is not enough to erase a lot of negativity that we've had for the past month or so. But we're getting to a point we're going to have to unload some of our longs. You should have been unloading at the technical levels I mentioned last week, but we're going to get out of a lot of the longs when we get to these territory here. But the AAII sentiment indicator shows still a lot of bears in the mix. 50% bearish is still pretty high, considering that 31% is the historical average. But the bulls are making a comeback from 20 to 29%. People are starting to become bullish. Just 1 week, okay, and they're still below the historical averages. So everything, sentiment is still bearish, even though the fear and greed index were technically speaking, when it comes to like market momentum and market breadth, you can see all the factors below on what constitutes this overall greed reading. If you go to the CNN fear and greed index, so those market momentum type stuff is at extreme fear still, is still below the averages, and yet we're getting into greed and the stock price strength and stock price breadth. So overall, it's greed, okay, but just starting to become greedy. So given the fact that we're at these levels, I mean, I'm saying it's neutral, but leaning towards bullish. However, what I would have liked to see is maybe the market drop to around the 550 level again, maybe even down to the 536, maybe not that much, around this level before it goes back up again, because that would make a good inverse head and shoulders if you want. But it doesn't really have to do that. Okay, I mean, we're still, if you look at the indicator share, the RSI, we're still in neutral territory. We still have a lot, like I was saying before, this is like a neutral setup that has a pretty much one-to-one risk-reward ratio, whether you want to go long or short. So there's no way I'm going to initiate any positions here because the risk-reward is not there yet. If you know, I was buying a lot here and I've been unloading at the 550, 565 and waiting to unload more at 575. And the 575 level, technically speaking, is the big level because it will be the Rubicon, the line in the sand. If we start trading above it and staying there for like a week or two, it's very bullish, very bullish. Especially since we have a lot of negativity in the positioning and in the sentiment going into this bullish setup. So I'm telling you, nobody expects new highs. I'm telling you, nobody does. Everybody still thinks it's going to be a recession. Okay. So that's pretty much it for the technical picture. Pretty much the same as last week. To recap, we just stayed in the same range for the whole week, thereby alleviating some of the overbought, if there were any overbought type of conditions, if you will. Okay, so let's get rid of the moving averages here. It's more of a cleaner picture. And let's move into the macro. The macro was fairly light. We had initial jobless claims as always. We look at it last week, we said note if it continues to go high, because this was a big one. If it continues to go higher, we have to be careful. But then, nope, this week back down. 228,000 on the initial claims. Big drop. So this is fairly good for the macro. As we said last week, the macro is still fairly good, with maybe one exception that was neutral. I can't remember which one, but almost every macro piece that was coming out this entire time, when SPY was even fearful here, was pretty much bullish. Except the one thing, which was credit spreads. But if you look at the macro and the credit spreads, this is the 1 year credit spreads between, this is the St. Louis Fed's spread between junk bonds, high yield bonds, and treasuries, okay? The lower the spread, the more that bond market participants think the market is pretty safe. There's no inherent risk in the market. It's a bullish sign when spreads are very low. People are willing to take on risk because low spreads means that people are buying high yield bonds, which means they are risk on, okay? And as you can see, this was the Trump move, boom, the Liberation Day, and it's pretty much coming down. Spreads are coming down nicely as we speak. Thereby, everything coincides. The fear is dropping. The fear greed index went from extreme fear to greed. As you can see here also, if I can put it in, the VIX is also down to 20, 19, 20 is like average volatility. So it's coming back down a lot. All of this coincides with falling yields. It's all different sides of a multifaceted coin, let's say. Multi-faced coin. So the one thing that we were worried at, that yields are high, well, it's going back down. Okay, so macro, initial claims down. And the other thing that came out is ISM services. That came at 51.6 for the month of April compared to 50.8 for March. So it's within a range, within the 50 to 55 range. And as you can see, we're still within that range, 50, 55 for a long time, okay? Services tend to hold up well even during recessions. I mean, maybe COVID was an exception, but anything above 50 for services is very good. So again, nothing to worry about. The macro is doing pretty well. So now there's nothing really to talk about this week in terms of special cases. So let's just recap what we talked about last week, which is gold. Okay, as you can see, gold this week made a crazy ride. Okay, which was it here? This is Monday. Boom, boom. After the Chinese May Day holiday, they started coming back and buying it with a vengeance. Sold off towards the end of the week, but still within the range. So this is like they're consolidating for this past week and this past, let's say, month or so, 2-3 weeks, month. So gold is consolidating. And like I said, the only negative thing about gold that I see going forward is the fact that we're going into Q2 and Q3, which is a historically weak sector if you look at seasonality for gold. So, but the fundamentals, everything is super strong. So there's not much to talk about here. I mean, keep an eye on it. But what you should look at, the big play in my mind is the GDX, okay, is the gold miners. As we said last week, okay, people were freaking out about gold, but it's still above this breakout point, the July 2020 breakout point, okay? Yes, if we go even further back, it's not as high as a 2011 high of like 66, which is the halcyon days of gold investors, which I expected to reach, but it's still breaking out above this level, which was huge, the $45 level, and staying around the 50, consolidating. So I think the play right now is in the miners, and I just shared a stock here. Like if you look at the under the hood of the underlying action, I mean, this is Lundin Gold, okay? Lundin Gold, mid-sized gold producer. Look at that. 2025 was here, okay? From 35, it doubled. Money's coming into the space, I'm telling you guys. This is the mid-tiers now. Like, we already saw AEM, Agnico Eagle, ripping, okay? Newmont, that's still a perennial loser. But, I mean, in 2025, did good. From 36 to 54. But, AEM is my favorite to go to. Barrick, gold, and gold, but let's say Barrick here. The symbol is gold, but I don't know why it's not giving it to me. Barrick Gold. Oh, no, it's not. It's B. Sorry. Doing well. From 19 bucks. Oops. Where's 2025? Here. 34 to 55. Interesting. But that's not Barrick Gold Corporation. Very strange. I thought Barrick was gold. Did it change it? I guess it changed its symbol. Okay. Whatever. The point I'm trying to make is that GDX and the gold miners underneath the hood are ripping. Okay. And if you have some gold juniors, the gold junior space should be ripping even more. It's pretty much the same chart. I haven't drawn the lines on this one as much, but the juniors, if you pick the right ones, okay, you can pick the index, but I wouldn't recommend it if you don't have any knowledge in the space. But if you pick the right ones, you're going to get way more return than the majors, and just by investing in gold. Okay, so just to reiterate, the space in gold is that I think the big play now is in the miners. Okay. What else did we talk about last time? Bitcoin. Yep, the 100 level. Playing with highs. Getting there. Selling some stuff here. You should be at least half off, okay? Because the move is being made, and we don't know where the S&P 500 is going to go soon. If it goes higher, then Bitcoin, you're going to see new highs, and good for you, okay? But I've sold half my position. Okay, a bit here and a bit at 100, not even at 103 when it went to 100, okay? So I'm just holding half. And if it drops back down, I'm probably going to get rid of the other half, just a trading position. If you're a long-term hodler, okay, congratulations, keep holding that part. But my trading position, I'm out of it. I'm out of half of it, okay? So I played some miners. So that's what I think about Bitcoin. As you can see, MicroStrategy too, I'm playing that too. That was my main holding. It's doing well. Also got rid of half of this, okay, this week. So Bitcoin, you could hold it, you could do whatever you want, but personally speaking, I got rid of half, okay? What else did we talk about? Oil, yeah. Oil, okay. This is where your trading becomes tricky and where some valuable lessons are to be learned, okay? So it broke down U.S. oil. I'm still bearish, okay? Oil went below this key level. U.S. oil, this is the WTI crude in the U.S., okay? It broke down. I got in around here. I sold a third here. And then it rips in your face when the news came out that, OPEC is not going to adhere to production quotas. They don't and Saudis don't care if the price goes down, okay? So as usual, it's a sell the rumor, buy the news type of thing. However, I'm still holding because fundamentally speaking, nothing has really changed. And technically, it's still looking bearish. Nothing has been violated. Although this rip in the past week is probably to kill the new guys that bought on the news, on the bearish news, when it came out around, around May the 5th, okay, around this week. So this is the whole week. The whole week it ripped, even though you had continuous bearish news. That's what happens. Everybody has already positioned here. All the big boys were positioned here short, and here they're covering, okay? Maybe not all, but they're covering some of their positions. So the market does whatever it does to punish everybody in the most maximum way it could, okay? And this is a case for these recent, if you shorted on the news, you're an idiot, okay? Don't trade off of news. The news is there for the people who had already traded before to get out. It's liquidity. You're becoming exit liquidity for the people who already knew and already are short before, okay? Don't be that guy. So what else happened? One thing we haven't looked at in a long time is the yields, okay? The US 10-year yield is the benchmark yield that we looked at because this week we had a US 10-year bond auction that was well received. It was stopped through, okay? Which is very high demand. And the reason I brought that up is that everybody's freaking out that the US this year has to issue a lot of debt because a lot of debt is maturing this year, okay? So that everybody's freaking out at the supply. So everybody thinks that the yields are going to increase because there's going to be a massive amount of supply. However, they're not looking at the other side of the equation, which is the demand side. There's still a lot of demand. Foreign investors are stepping in and buying because they require dollars. The US dollar is a US reserve currency. And they've issued a lot of US dollar denominated debt, and they need US dollars. And they still do trade with the US, although maybe not as much now, but they're still required, or there is a requirement for these foreigners to purchase bonds in order to park their excess US dollar reserves in. So even though we're still at the highs, we're in a neutral territory here. Neutral territory meaning that we're in this range of the US 10-year yield. I don't think it's going to change much, especially since we have falling inflation. So these yields should be falling. And if we have a recession that people are saying, these will definitely fall. Okay. So, I mean, I don't see a catalyst. I mean, I wouldn't be in products like the TLT, which is like the 20-year bond. I mean, I don't see any catalyst that's going to move either way. And you don't want to be in stuff that's not going to move. So you're just tying up your money here if you're investing in the TLT, okay, which is just a mirror image of the US 20-year, which pretty much operates the same as the US 10-year. So if things are going to stay here unless the Fed really cuts or really increases rates, and I don't think we're going to hike rates anytime soon. So I don't think this is a place to put in your money. But looking at the 10-year tells us that the Fed is the only central bank in the world that is not cutting rates. Everybody else is cutting rates. Okay? And the Fed is doing that because the U.S. economy is still very strong. Our macro is telling us it's still strong. Not amazing, but GDP between 2 and 3% is still hobbling along. You're still going. You're still increasing, even though, albeit at a slower rate. And this is what this is telling you. This is what the U.S. 10-year is telling you, that the U.S. economy is still strong and that they don't think the Fed is going to cut rates that much going forward because the U.S. can take it. So will we get a recession later on this year? That's what everybody says. Literally, everybody says we're going to get a recession. Are we? I don't know. The market is saying no. Market's not scared. We've recovered a lot since the fear of Liberation Day. So, let's reiterate, okay? Looking back on this week, nothing really happened. The U.S. economy is still doing well. Macro is positive. We have falling spreads. And the market's back. I don't know what to tell you. I mean, we could go down. I'm expecting it maybe at 550, 536, like I said, maybe form a inverse head and shoulder so you can rip to new highs. I don't know. But when nothing is happening, when there's no fear, no catalyst, the market tends to drift up because of all these passive flows that are coming into it from hedge funds, pension funds, whatever. Okay? So will we get a recession? Maybe. I don't like to dwell on things that I can't control. I just like to look at things that I can control, and I see that the data is okay. There's nothing wrong. And that maybe tariffs are not that bad. They're bad, but not devastating like, I don't know, a pandemic shutting down 50% of your productive capacity. I don't think tariffs are going to do that in term equivalent wise. So, neutral to bullish. So far neutral only because we're trading below the 200-day. That's it. Once we go above it, once we go above and trade above for a couple of weeks, there's no reason to stay bearish. The one bearish element out there will have been taken off the table in that case. So that's it, guys. Looking forward to next week.